All right, well, I think we'll get started. Um, Thank you everyone for attending our webinar today. Our special guest is Summitry, Alex Katz and John Way. They're a financial advisory firm that works with us at Intero. I'm gonna start with a very, very short, brief real estate market update. Looking at the numbers for Santa Clara County, the median price from August of last year for single family homes was 1.19 million with a median days on market of 18 days, right? Which is pretty good. But compared to August 2020, right? So the month just ended, the median price is now 1.4 million with the median days on market of half of that. So 9 days on the market. So there's been quite a change, right? Since last year, all kinds of stuff have happened. But I think as we'll get into in this webinar, I think the Silicon Valley real estate has been pretty durable in that. But let me pass this on to Alex Katz at Summitry, and maybe he can give a little brief overview of how this works.
Yeah, thanks, Eric. So just very, very quick introduction to our firm. So Summitry is a Bay Area based and Bay Area focused wealth management firm. We work pretty much exclusively with Bay Area executives, Bay Area professionals, and our firm focuses on the financial concerns that come with life in this pretty unique place that we call home. These are things like concentrated stock positions tied to RSU income and ESPPs and all of the things that likely many of the folks on this call today have as part of their financial picture. Another big Bay Area financial concern is real estate. And as we like to say, there's no such thing as a small real estate decision if you live in the Bay Area. And even if you just own your primary residence, it's probably a pretty significant part of your overall wealth, your overall balance sheet. So our firm, as a Bay Area focused wealth management firm, spends a lot of time helping people with real estate decisions. And ultimately, that's what led to our partnership with Intero about 1.5 years, 2 years ago. And it's been a wonderful collaboration thus far, where we can really become involved whenever a client is considering a real estate decision. And that could be, inheriting a property and not knowing whether it makes sense to keep that as a rental property versus sell that property and perhaps invest in a different rental property or invest in some other asset class. And certainly as we get into the realm of investment properties, which of course is the topic of the day, there are many, many layers of sophistication that can be applied to that analysis and those decisions. So I'm delighted to have John Way, my colleague, join us on the call today. We have about 12 advisors on the team at Summitry, and John is the only of our advisors who is both a certified financial planner and then also a certified private wealth advisor. And certified private wealth advisor, for those who don't know the designation, is kind of a higher level distinction on top of the CFP, where John has specific domain expertise speaking to higher net worth concerns like investment real estate. So certainly John has the book knowledge when it comes to investment real estate, but then he also is an investor in real estate just personally. So it's not all academic for John. It is embodied knowledge as well. So I was delighted to be able to bring John to this call, and I guess I'll turn it back to you, Eric, to kind of start with the questions. And John, thank you for being our domain expert today.
Pleasure.
Yeah. So really briefly, if anyone has any questions, please use the Q&A function, and then probably we're going to talk for about 15 minutes doing a Q&A with us, and then we'll answer any questions that everyone else has as well. So I guess starting off, John, maybe give an overview of maybe equities versus fixed income versus real estate, and then I think maybe even break down real estate to maybe commercial, residential, just like a general complete overview for folks that are maybe not as aware.
Sure, yeah, totally. So we'll start out, I guess, with equities, bonds, fixed income. So equities, in essence, I mean, it's a it's a paper asset, right? Well, nowadays it's an electronic asset. So it's more like, supply and demand. So what's the buy side and what's the sell side? And then, people get together, decide on what the price of the asset is. And so, in terms of what Summitry does was we evaluate, equities on fundamentals. What's this company really worth compared to where the value is, what the supply and demand says right now. In terms of fixed income, very much the same. So supply and demand, and so some bonds are basically debt structures, right? So it could be corporate bonds, basically debts issued by corporations like AT&T, Wells Fargo, companies like that. That issue out debts. It's a fundraising for them to raise capital, working capital for the business. It could be bonds issued out by counties, San Mateo County, Santa Clara County, California, or those are sort of municipal bonds, right? So those are issued out by the government, local government, by to raise money for operations, right? So and those can be first issues, or though most of the bonds currently is sort of traded on the secondary market. So it's sort of if I had bought a bond 5 years ago, paying like a 5%, I could probably go out and sell the bond for a pretty high price now because there's no bonds that's paying 5% right now. So, so again, supply and demand on the bond side. On the real estate side, I think to break that down, sort of, I think there's 4 areas that you can sort of. I know real estate is sort of a broad topic, but
Sure.
when we talk about real estate, we're talking about like California real estate, and outside of California real estate. So California real estate, if you break it down, is sort of residential versus commercial, right? And then so residential is supply, demand, and location, right? So and also on the commercial side, you have a lot of different types of commercial. So you have industrial, you have commercial retail, you have office buildings, you have apartment complexes, and the list goes on. So and the evaluation for those is a little bit more technical. A lot of it is based on cash on cash return, internal rate of return for calculating the actual value of those properties, whether it's before or after renovation. So commercial, that's sort of like within California real estate, and then you got a whole set of different types of valuation, like outside of California, because California is a different animal when it comes to real estate in general. So you got the outside of California real estate, which is a lot of where investors are going right now to get the higher yields, right? So in places like Austin, Texas, or Texas in general, Arizona, East Coast, North Carolina, the southern east, or south, mostly southern and southern east states, to provide sort of a higher yield, higher return. So that's sort of a really quick overview of sort of definitions in terms of my definitions of equities, bonds, and real estate.
Yeah, so I guess diving deeper into that, like how would you say the difference between like residential versus commercial real estate in California? Like what are you seeing on that front right now in terms of your clients, right? Like
yeah, so residential real estate, I think in California, I mean we all know that like residential real estate is location based, right? So like it depends on where your location is, and then that kind of determines what the growth rate is, and how sturdy or how stable the value or the growth rate of that area is. And certain areas could be really a hot pocket, and that could never go down in value. Even in 2007, 2008, right? On the commercial side, I think with in terms of commercial valuation in general, it's really based on cash flow, right? So what, based on how much you invest into the project or into the property, how much can you get out of it in terms of cash flow? California being the place that it is, in California, mostly, it's a blanket statement, and I don't want to put it that way, because I mean there are maybe some properties that may provide like extremely higher yield, but most California commercial is not, you can't get the higher rates as outside of California. And and when I say rates, it's basically return on your cash, return on your investments.
Yeah, so like what would you say to someone that has a investment single family property, right? Say in San Jose, worth about 800,000, and they're getting about $3,500 a month in rent. Like, is that a good stable investment, or are there potentially other opportunities out there, either in commercial or even in equities or fixed income, that they might be able to look at to have potentially higher returns?
So 3,500, and I want to specify, so is that net of all costs for a residential property?
Sure, let's say that's net profit.
So net profit, I mean, that's like 3,800.
35.
It's pretty good. I'm a 3,500. So that's about 5% roughly, right? About 800,000.
Sure.
That's, I would say, I mean, that's pretty decent return. I mean, where we are in the marketplace with everything going on, I think that's decent on an $800,000 property. Yes, that's pretty decent. I mean, if you're looking to get a higher return potentially, yeah. So 5% for California, that's pretty good.
Okay.
Right? 5% when you compare it to outside of California, that's somewhere below average.
So like you mentioned Texas, right? So like what kind of rates of return, cap rates, are you seeing out there?
Depends on the project and depends on the property. So I mean, the range of returns could be anywhere from 5% to 12% or 13, 14%. So it depends on the property.
Sure.
So yeah, so it really depends on what you're trying to get into, and if it's a development project, if it's a fix and flip, or if it's a buy, rehab, and rent and sell.
And Eric, just to underscore that point for the folks on the webinar, each of those different types of projects is going to have a very different risk profile.
Sure.
And so for different investors, assuming the different risk of those different projects may be appropriate within their overall balance sheet and may be inappropriate as a significant percentage of their balance sheet. So that's where really scrutinizing the investment in a larger context is important. And then just underscoring the point that John made, yes, finding a 5% cap rate property in San Jose would actually be very unusual. A lot of our clients who have rental properties in the Bay Area, it tends to be more in the 2% cap rate, 1% cap rate.
Yeah.
We were speaking with a client yesterday who has a Portola Valley rental, and her cap rate is, I think, 1.3. The strategy that those clients, whether explicit or implicit, the strategy that those clients are applying is an asset appreciation strategy as opposed to a cash flow strategy. So the key is understanding that not all, even if it's just residential properties, not all strategies are the same. Different properties are going to have completely different outcomes. And where a Bay Area property may appreciate significantly more than a property in the suburbs of Houston, that property in the suburbs of Houston would have a very different cash flow parameter. So it's just understanding those trade-offs.
Yeah, that's a great point. And then something else I wanted to touch on was 1031 exchanges. Maybe we don't need to go into too much detail, but based on potential, I guess, things that might happen, right, in the future on that 1031 exchange side, some potential risks, I would say, that have been discussed, right, in Washington. Yeah, maybe if we can just touch on that very briefly.
Yeah, totally. That's a really great question. So, you know, with 1031 exchanges have been around for a long, long time, and a lot of and it's really beneficial. It's a beneficial tax rule that allows investors, investors of investment real estate, to defer their capital gains on their investment real estate and then roll them into the next property. So in other words, if I own like a rental property, whether it's a duplex, quad, or triplex, or a 10, 50 to 100 units, like, you know, if I sell it, I actually identify like a property within, you know, 45 days of the sale, and then within 160 days of the basically finish the purchase within 160 days, then I don't have to I can defer my capital gains on my first property till the second property. So basically roll my equity and save on the taxes until and pay later, right?
Yeah.
So that 1031 exchange rule has been around for a long, long time. Now, it's one of the items I think on the Biden agenda is basically it's to potentially eliminate 1031 exchanges, but that's to be determined, right? So I mean that's sort of one of the agenda items on the tax proposal. But you know, we'll see, because I mean, for anything that's significant to change, we need the maybe a like a Democratic Congress, and also like having, you know, Biden elected. So that's a lot of ifs, and also, like, you know, there's a lot of and I think I would say uh, politicians in Washington that also have a lot of real estate assets, and that, you know, that could potentially alter the decision too. So I mean, that is on the agenda item to be discussed. I think, I'm pretty sure, once election is over. So and to be on the watch out for investors, specifically real estate investors, moving forward, just to look out for that potential change.
Yeah, thank you so
So
much.
Eric, I
Yeah,
would
go
just,
ahead.
well, I'd just piggyback on that, that what we're telling our clients is, if you're considering a 1031 exchange anyway,
Yeah,
because you have an investment property that doesn't perform particularly well, or you want to move from an asset appreciation strategy into a cash flow strategy tied to a life change, maybe you're retiring, whatever it might be. If you're considering that anyway, the fact that the elimination of 1031 exchanges is even on the docket of considerations may influence the timing of that decision. And 1031 exchanges don't happen overnight. So if you are one of those people, it creates a little bit of urgency to consider that sooner rather than later. But the huge caveat in that is exactly what John said at the end of what he just shared, which is, for that change to be enacted, we're talking about an administration change. We're talking about a candidate's tax proposal being fully implemented as described as a candidate, and having the congressional support to make that happen. And there are significant special interest groups that are certainly would be highly and vocally opposed to the idea of eliminating 1031 exchanges. So there's a lot of variables there. And yet, if it's something you're considering anyway, it's good to know, eyes wide open, what the candidates are talking about.
yeah, thank you so much, Alex. And then the other thing I wanted to discuss very briefly before we go into the audience Q&A is the eviction moratorium, right? So there was recently legislation passed from the state level, pushing it to next year. And so we still don't know everything that's gonna happen, right, between now and when that next eviction moratorium ends. But that's something that investment property owners and landlords need to be very aware of, right? That essentially, since the pandemic, evictions have been halted. And so that's something to also keep aware of, right, with the news and with specifically California and even all the local jurisdictions, the different laws and rules on that front.
Yeah, so I mean, speaking to that, I mean, this is also where the difference of California real estate versus outside, out of state real estate, really kind of comes in, and really depends on where out of state. So I mean, California real estate in the past, I don't know how long, 10 maybe 20 years. It's California is a tenant friendly state. So what that causes is that for renters, it's favorable, because they, I mean, because of the whole eviction moratorium now, like you can't evict people, you can't evict your tenants, right? So it's illegal. So,
Yeah.
but in certain states, certain counties outside of California, that they're like landlord friendly, right? So that they are able to, evictions is still going on, and evictions are allowed, and it's basically legal to do it. And so, but with, like you said, with the whole COVID situation, it makes it hard for even those states currently, because courts are closed because of the COVID situation. So a lot of courts are actually doing Zoom meetings for hearings, and tenants will have, and this is, I believe this is across the whole U.S., that tenants will have the option to choose if they want to have Zoom meeting hearing, or they can wait till an in-person meeting to actually basically, if they choose that route, then the landlord will have no say but to wait, but to have them squat in the property and basically wait until there's actual hearing in person, which we don't know when that will be.
Yeah. So we have the first question from the audience. This will be to, I guess, Alex and John. How does Summitry help me assess a real estate investment in the context of my overall wealth?
Yeah, I'll start on that. John, feel free to chime in if you want to add. So the traditional way of thinking about affordability of real estate, or let's just say this is a how much home I can afford kind of a question. The traditional way of wrangling with that question is to basically look at a snapshot of what your life looks like today. What's your income today? What are your expenses? How much of a mortgage payment could you take on? And then to call that your affordability. What we're doing is taking a much bigger step back and not only looking at what your life looks like today, meaning your financial life today, but forecasting that out into the future through some pretty sophisticated financial planning software that we have, and then modeling different home purchase scenarios into that software, where let's say you're considering a $1.2 million purchase, a $1.5 million purchase, or a $1.7 million purchase. Being able to see the outcome of those multivariable decisions in the software allows clients to have a lot more perspective on how this will impact their downstream financial future, as opposed to just attempting to make a decision based on what today looks like. So, that's a big piece of it. If it's investment property, and I'll go back to the example I gave at the beginning of an inherited property, we want to objectively look at that property with a client and say, as John has alluded to many times, what's the cap rate of the property? What's the total cost of ownership? And objectively make a decision if this property actually performs as an investment. And once we have some determination there, then we can look at alternatives. And if it's, do I keep this as a rental or sell it and 1031 into another rental? We want to look at other properties and evaluate them just as objectively as investment vehicles as well. So that's a bit more tactical, but that decision around owning rental property, again, as I referenced earlier, it's all going to be contextualized. If you have a $10 million net worth and $9 million of that is in real estate, you might have a liquidity problem on your hands. So we want to make sure that your balance sheet is actually properly constructed to support your lifestyle.
Yeah, the next question, if anyone has any questions, please continue to post them either in the chat or in the Q&A, is how sensitive is real estate valuation to interest rates? In other words, are cap rates correlated with interest rates? It's a good question.
Yeah, good question. So I think to a certain degree, it is indirectly affected. And the reason why I say that is because, I mean, interest rates, and when we say interest rates, I'm assuming that we're referring to the federal funds rate. You know, if the Federal Reserve come out and they set the rate, the sort of the standard rate, and then everything else sort of attaches themselves to that or evaluates their own rates based on that. And so, in essence, it does affect the cap rate. So on a very indirect sort of way, say for example, if interest rates actually, I mean, we're at like pretty low interest rates historically, like all-time low historic rates. How does that affect cap rates? It actually lowers the cost to borrow, right? So when it lowers the cost to borrow, it lowers the overall cost to maintain a property. And so when that happens, then your potential cap rates, your cap rates could potentially go up, right? So, but then there's also the overall, like, sort of going from the other way is that when you're viewing, so when we say cap rates, we typically don't look at it in a way that we're talking about like commercial realty. Residential realty is, I mean, it's sort of, rental property, yeah, you could use cap rate a little bit, but then, you know, residential real estate, like the value of the property is really based on like what I mentioned before, supply and demand, right? In terms of commercial realty, is sort of like the cap rate really comes in place in terms of determining the price of the property. And so cap rate, it is affected in the commercial real estate arena, but then it's not the whole. I mean, sorry, interest rate is a determinant, but it's not the only determinant, I would say, because there's a lot more that gets factored into commercial real estate evaluation than interest rates.
Yeah, good answer. Are real estate investments a competing asset class to stocks and bonds?
That's a very insightful question. So we get this question occasionally because we're a wealth management firm, and when we invest on our clients' behalf, we're typically investing in stocks and bonds. With that said, we are also a fiduciary, meaning we must put our clients' interests before our own, and we want to be objective in the guidance that we give our clients. So if a client comes to us and says, hey, does it make sense for me to purchase a second home up in Truckee? And here's what I'm thinking about from a purchase price standpoint. What we want to do is first and foremost understand their narrative about what owning that home means to them and their family, whether it's a legacy or an investment or a lifestyle investment that they're making. And then show them the impact that that decision would have on their long-term financial well-being. It is not our place to make a decision for our clients whether or not they should or should not do something. It is our role to provide insight and clarity into the impact of those decisions. And we take great pride in the fact that the guidance we provide our clients is independent of what it may mean to Summitry from a assets under management standpoint.
All right, I wanted to keep it to 30 minutes. So we're at 2:29. So thank you to Alex and John for participating today. And if anyone has any further questions, you can reach out to both me, Alex, or John, and we can continue the conversation from there. So appreciate everybody's time. And
thank you, Eric.
Thank you for having us.
Yeah, have a good afternoon, everybody.
Okay.
Bye-bye.
Take care.
Thank you.